Ooh. Man, welcome back, guys. Hey, it's me, Jonathan. Welcome back to Money Talks, and we're going to talk to you about stock price. Yes, stock price. So, if you've been following my channel for a little bit, you understand that I'm a freak of nature advocate for index fund, total stock market, S&P 500. So why am I talking stock price? Well, now I'm in the phase of my investing where I start to diversify a little bit of the portfolio. Definitely been good. So if you've been following index funds, I'm gonna definitely have more content coming on that and index fund and the value of index fund and understanding it and kind of building out your portfolio. But the key in any piece of investing is diversification. And one of the things about investing that I think we oftentimes miss is when you invest and when you diversify, diversification is really the speed at which your money doubles. So if you have an index fund, your money can typically double on average about 7 years because an index fund, by the rule of 72, usually based off the total stock market, usually does about 10 to 12% on average. Obviously, right now, or even over the past 10 years, that's a little bit higher. But on average, you can expect your money to double what's in the account without you adding anything to it every 7 years. When you start to diversify the other pieces of money or different avenues for investing, say dividends, say just single stocks, your rate of returns as far as how long it takes for you to for your money to double, that can start to compress to less than 7 years. And why do you do this? Because you want to have your money doubling at different speeds so that you have more money being printed for you. It all works together for good. Now, it's not a bad thing, honestly, if index funds is a great avenue for you and you like the speed and you like how they invest, it's nothing wrong with doing 100%. But when you really start to build out a full portfolio, having different speeds of which your money can double allows you to make more money in the interim in your investing journey. So the stock price, that's a key to which we're talking about today. But the stock price is a determination of what you should pay for each share for an actual company. The stock price is usually determined off individual in many different factors. So it can be economical. It can be what's going on in the weather, the economy, industries. It could be just wars can impact the stock price of a company. So there are many different things. But what I want you to understand and what many often miss is the fact that your stock price is literally dependent on supply and demand. That's how it plays through all those different factors. Yes, it can matter how it's profitable, but I also want you to look at that the stock price is a moment in time. Because if you ever try to buy a stock, and if you bought a stock, please let me know in the comments what was your first stock that you already bought. What was your first stock that you bought like ever? I'd really be interested. But if you've ever purchased a stock, you know if you watch that stock throughout the day, that price can go up, go down. It's really moving real time. So it's important that you understand that things happen throughout the day. Legislation, conversation, business takeover. Many things can happen throughout the day that can affect the stock price. If you start to think about some of the situations that we've already had. So we've had Facebook change its name. Huge thing. AMC, huge thing. Bitcoin, huge thing. Dogecoin, many different things. It can all affect the stock price when somebody sends a meme or when something catches wave on the internet. The thing about the stock price, however, that you need to be aware of is that just because it took a dive or it went low doesn't always determine the value of the company. It could if a company was actually going bankrupt, Circuit City, Toys R Us, things of that nature, that would affect the stock price. But if it's simply taking a dive as far as, hey, many people are just panic selling, something got caught up in the news, that means you might have an opportunity to actually buy a stock at a lower price, which is the discount that you hear so much about, but you're going to make more money because you bought it at a discount, bought it lower, and when it comes back up, you would have made more because it would have came back up to its normal evaluation. So I would encourage you, really start to learn and really start to look at the stock price. When you, obviously it's the determination of how many shares you can buy at a particular time. But I also want you to think of, when you're looking at the stock price, really start to look further and take one step more to, what do I think this business is going to do? So, like for Tesla, you can see that as Tesla has grown, many things can affect its stock price. And though I wouldn't consider it as much of a newer company, it's got a good 10 plus years running. I would say you have opportunities as it's growing, as it's expanding, as it's adapting to the economy, that you can catch that stock price when it comes down lower, when the events happen, you buying. But if you really believe in the concept of what Tesla's doing, and if you really look at the future plans of how it's going to grow, you will be able to catch some of the wave and be a part of its building business. So, stock price. This is what you're paying to buy essentially a business. So when you buy a share of a stock, you own that business. You're a business owner. So it's important that you evaluate your decision to buy and purchase a piece of stock, any business, real estate, whatever you're buying. You're making a business decision. We buy stocks using strategy. We don't buy it with the idea of, hey, this feels good or this is something I like. We buy it with the fact that my vision, and I agree with the vision of the company, but I strategically know what this company is going to do. Not necessarily, but based off the information you're saying, I can see the growth coming. And that's why you use the past performance to give you an indication of how did they handle some of their problems. When you start to build out and start to learn how to fully evaluate a company, you will start to look at factors like cash on hand. How much debt, budget, liability do they have on hand? If they have to stress test, meaning if they have to dissolve the business right now, can they even pay their bills? All these things are factors in what determines a stabilized stock price. I hope you guys enjoyed this video. I hope you learned a little bit about stock price as you're going on your investing journey. If you like this video, go ahead and give it a thumbs up. If you haven't already, please subscribe to the channel. I can't wait to see you guys in the next video.